All right, good morning, everyone. Let's get going today. We've got a big day today ahead of us. A lot of stuff happening. All right. First things first, get into last night's session. U.S. markets. We had a bit of a erratic session there. You can see that one really quick spike down around 2 p.m. That was obviously there where the FOMC statement came out. You know, it was a little bit of obviously kind of a wobble there for a second because she continued her stance that rates will remain unchanged for a considerable period. But she did make a slight adjustment in there that I think gave markets a touch of a wobble, but definitely still saying that that markets are going to be they're going to keep rates loose for a considerable period. It wasn't enough to shake markets out to think that they were going to make the major change to language and really see rates on the immediate horizon make a change. So markets were able to kind of shake that off and managed to hang on for the session. FedEx and Lennar both had a nice session after having some earnings beats, but the Fed obviously was dominating the day. If we look into Asia, we had a bit of a mixed action out of there. We had some really soft numbers out of China, again out of some of the homes data. We continue to see that those numbers just be really, really poor across the board. The Nikkei really got its big boost, obviously, because of the huge sell-off in the yen, which obviously really gave the exporters a big boost there. You've just seen the such a big move in the yen over the past month, and it's really just driven the exporters and just the Nikkei in general through the roof over that period, and it's really been probably the best outperformer because of it. Other than that, not a whole hell of a lot going on. We did see, same sort of thing because of the homes numbers. Real estate developers in China continue to be the underperformers. Probably been one of the best shorts over the past year or two there. But what I think is obviously forefront on everyone's mind today is the Scottish independence vote, which is going to be happening throughout the day there. We're going to have to wait and see what some of the early counts from that poll are to see if we have any real impact on the market as of the day today as we go along. So just watch that really closely as that progresses. Obviously, the no vote looks like it's probably gonna win out, but if things are still looking tight later in the day, or if as the yes vote, if it shows any sort of lead in the late morning sessions, I think the market will start to react adversely to that. If you're playing here locally, that's really going to affect obviously the pound. So some of the dual listeds will really come under pressure as if the pound weakens under that scenario. Like I said, if the no vote looks like a clear winner early, we could get some strength out of the pound early. I think it's more or less priced in, but we still may get a little bit of strength, which obviously will have the opposite effect, take our dual listeds in London a little bit higher. So just keep that in mind today as we go throughout the day. Today is, before I forget to mention, it is also futures closeout here locally today, so we are going to have an auction in the middle of the day, and things will get broadly out of kilter. So I'd be very careful after maybe the first 2 hours of the session to really try to get involved. I'd probably try to be patient and wait for that and wait for the closeout auction. All right, really cool chart here out of Charts of Interest. We've got the approximate pace of policy firming. This is from the U.S. Federal Reserve, and this shows where each member in the Fed thinks that rates will be in the future, and is plotted on this chart in a dot. So you can see here there was one jackass that thought that in 2014 rates would be at 1%, but every single other guy thought that rates would be exactly where they are, down at 0.25%. Going out into 2015, you still got two people that expect rates to continue to be that sort of level. Everybody else is higher, and pretty much everyone else is at 1% or higher. It's probably the same schmuck that at 1% that's up here at 3%. Other than that, everybody mostly between 1 and 2%. And then things continue to have just a drastic spread, especially in 2016, which is really the widest spread. We've got guys all the way down from 0.5% all the way way up to 4%. I mean, it's actually quite evenly spread. So the point in showing this chart is just to show how up in the air the future of U.S. interest rates really are. So, I think the markets can typically actually know better than what some of these Fed members will actually know. So we'll continue to watch the bond market as we go forward. I'll show you a chart in the bond market in a little bit, and we'll look at it as that evolves and as yields start to move, where we think that monetary policy is going to shape because of the bond market, and the bond market really will force the hand of these guys anyway. So I think that's really where we get the most guidance from. But bottom line is, even the Fed members have no freaking clue where interest rates are going to be in 2 years. So that's just it's incredibly interesting. It leaves a lot of room for scope for volatility into the future, which I think is great for you as a trader. All right. Remgro had full year numbers a little bit earlier today, basically kind of coming in line with a trading statement and guidance, right in the middle of guidance. You can see the divvy per share more or less in line. NAV at 128.56 per share, which seems a bit light to me. I'm not 100% sure that that's completely accurate, but anyway, the numbers for Remgro look broadly in line. If we look at, we also have Investec, which is going to come out with a sales and revenue release for second quarter today as well. All right, in terms of market data, we've got Japanese trade balance that we had a little bit earlier. We've got machine tool orders, or have machine tool orders as well, a little bit soft. We've got UK retail sales at 10:30, and then we just get into a big spate of data out of the States: initial jobless claims, housing starts, building permits, Bloomberg Consumer Comfort, and the Philly Fed Business Outlook. And then later, we've also got interest rates, which are going to be announced as well. So we've got a lot to kind of look at today. It's going to be a very busy day going into tomorrow as well, with tomorrow being a big day ahead of the Alibaba listing in the States. So a hell of a lot going on the next couple sessions. We could see some real interesting moves over the next couple days. All right, let's get into the maps. All right, the main thing obviously that happened overnight, obviously the dollar catching fire, the commodities really kind of coming under pressure on the back of that as well. We'll have a quick look here at the US dollar yen, just to kind of keep you guys in the loop. Obviously we talked about this last week, or possibly a little bit before that, and how these drastic moves in the FX market and the bond market and the commodities markets are really going to drive volatility for us in the equity market. You can see we had a little bit of a little range there over the past maybe week and a half, somewhere around 107 to 107.50. We ripped out the new lows on the yen, multi-year lows. I'm talking about 4 or 5 year lows, if I'm not mistaken, in the yen, and we popped up almost to the 109 handle this morning. So we're trading around 108.66 at the moment, and we just continue to see one-way traffic out of this dollar. The guys have got caught, obviously, with not high enough expectations for the US dollar. We've also seen a big breakout from last night. We saw a big breakout of this little consolidation out of this little bear flag on the euro dollar, and the euro really dropping to new lows versus the dollar. It's one of the heaviest positions that have been long dollar, short euros in, I think, since the European debt crisis a couple years ago, and that's saying something. I remember we had an enormous reversal when the markets finally did find their bottom around 118 on the euro dollar. I wouldn't be surprised if we see at some point we'll probably see capitulation in this move, and then that's when you see the big reversal. So wait for a couple percent move to the downside in the euro before we potentially can see a reversal back the other way. All right, let's look at U.S. Treasuries. So we right now is okay. So this is the 10-year U.S. Treasury. We'll look at this one at the moment, and you can see here we've been in a hell of a downtrend here. and really looks like we finally put in a bottom into treasuries, and we finally dropped out of this downtrend in terms of yield. Sorry, put in a bottom in treasuries. I'm talking about a bottom in yields, a top in the actual price of the bonds. So you can see here we're up above 260 on the 10-year treasury yield. We're coming from all the way down at about 230. In percentage terms, that's an enormous move. Definitely looks like we've put in a bottom. We're starting to see bond yields turn across the board in the States, and that's even coming on the back of the bond yields across the water, across the pond, really falling over in Europe and everywhere else for that matter, falling to new lows. German 10-year yields dropping below 1%, so there's a real counter trend going on here. And U.S. Economy looking very strong, them starting to forecast a hike in rates. The consensus is starting to look like spring of next year when we start to get the first rate hikes, quantitative easing winding down in October. So I think the bottom, the bottom in yields may be in U.S. Treasuries. This has been kind of a hedge fund killer for several years. Guys just bleeding out forever in this position as it goes against them. Jeff Gundlach, who's kind of probably one of the most, if not the most respected bond guru at the moment, says that he thinks the bottom's in for bonds now. So I think that we probably have seen the bottom. We're breaking out of this downtrend in terms of yields. I think we can see an upside from here, and obviously that's going to be part of what shapes monetary policy in the States going forward. So it's interesting to keep an eye on. We'll keep gauging that as we move forward. All right, Kumba, let's get a little bit quicker here. We've still got a lot left to show. Kumba also forming a little bit of a bear flag, hasn't really dropped out or descending triangle potentially. It may be ascending triangle, sorry. Either way, looking a little bit bearish there, looking ready to potentially break out to the downside. It's really been struggling yesterday. Shocking session, especially after the Chinese came to the rescue a little bit to some of the banks. Absolutely no bounce, opened up and traded down the whole day. Along with the rest of the commodity space. CFR, we'll look at 2-year. I know we showed this yesterday. I just wanted to go back to this real quick. What's interesting about this, there's so many major places where you're dropping out of. So obviously we dropped out of this flag pattern that was here. We'll zoom forward now. You can see we dropped out of the flag pattern that we were forming down here, a little island reversal. Not only did we drop that, but we dropped major support at 101, at $100, which we had really been bouncing off of. So I think no matter how you shape it, we dropped under major support in terms of this trading range. We dropped out of this flag when we've dropped below psychological $100. I think this thing has more downside to it potentially. I really do. I think this is big. I think we could have another 4 or 5, maybe even $6 a downside here on CFR. So just keep that in mind. I think looking for a second day play there could be interesting. I wouldn't be surprised to see us come under pressure in CFR today again. And watch for that one today. All right, Tiger Brands. I just wanted to jump back to this real quick. We've been going over a lot of the same ones, but some real pertinent setups in the market at the moment. You can see here Tiger Brands yesterday dropped back below that the point where we broke out from at 316. Still looking like a bull flag here, but definitely yesterday looking a little bit soft. I think we're going to need to see a little bit of confirmation to see us push a little bit lower. If we do push a little bit lower, then this could be a bit of a failed breakout, and we could see Tiger Brands get heavy. If we do get back above 316, then I think we could reverse back up to our 330 target. So watch that one closely today. Imperial, the last local one we'll show, really just dropping major support here around 187. And making a little bit of a bounce up to that level. Tested it yesterday. Not real impressive. I think this really to me looks like a setup to a test on resistance. What was support now becomes resistance and then fails off of there. And I think we've got a much lower target in Imperial. The last one we're going to show is SA Breweries in London. And the reason why I wanted to show this one is it's gotten sleepy. As the rumor mill dies down, you can end up seeing a little bit of complacency complacency here, maybe a bit of a drift back down to this level, which I think is an exceptional place to look to be able to add or get involved in SA Brews. Remember, this is the London chart, so 34.70 £. So watch it if we pull back into that level. There's a bit of a similar type setup or level in for us locally as well that we could pull back to maybe around a touch south of 420, which also be a great little spot potentially to have a nibble here. And that's it for today, guys. Good luck out there. Don't get caught up in that 11 o'clock to close out period today.